But if we focus on all of those things that we think serve to take our money, then we can pretty much guarantee ourselves that we will not be effective. And even if there's high frequency trading and dark pools and those other things out there, they still leave a trail. They still show what their interests are. They show what their where they're getting aggressive, where their conviction levels are, where they are weak, where they have belief, where fair prices are and unfair prices are. And as we look at that in the most current context and then start moving out and out, we can start to put together a picture of what we know about them, regardless of where they are or who they are or what their intent is. So I want to make sure that we get through some of that right now. Buyers and sellers are the market. And when I talk about buyers and sellers, I mean active buyers and sellers. The one thing that you will never, ever be able to do as a trader, and you can just lay this aside right now, is identify or understand who is sitting on the sideline that's ready to step in and push price one direction or another. But the buyers and sellers of current activity that are engaging in pushing price up and down, they are the market. It doesn't matter what somebody on CNBC says or in an article or a newsletter. In fact, it doesn't even matter what I say. The only thing that is going to move price and determine where price is going to go are the buyers and the sellers. And let's face it, I personally don't know of any retail traders who have the ability to move the market, especially in the ES. And again, only active buyers, sellers can move price. Why is this important? It's important because so many people start focusing on the things like the dark pools and what might this do, what might that do, that they miss the opportunity because the print and the auction is telling them something very clearly. And if you understand how to manage your risk well, you can keep yourself from any significant harm by understanding where to trade and where you need to get out. But when people focus not just on the active buyers and the sellers on what could happen, they start to create a certain psychology that prevents them from being objective. So only active buyers and sellers can move price. What that means is what we see in the print, what we see in order flow becomes incredibly important. It is what we know. It is all that we know. Outside of what we see in the print is uncertain and ambiguous, and the market will always be uncertain and ambiguous. And as long as you can deal with that and understand that, and I have a lot of people that say, yeah, I get that. We know. But they don't know relative to making their trades and specifically managing their stops. So it's very important for us to understand what we see in the print is all that we can know. What we read in the volume profile is all that we can know. We make our trades based on what we know. If we're wrong, we have more information and we move on. If we're right, then the market confirms what we're reading in the structure and what we're reading in the print, and we keep moving forward in that assessment. Now understand also that price movement is what makes our trades win or lose, and that's so obvious, but it becomes fundamental as we get the print. Therefore, we only want buyers and sellers to influence our trading decisions. Nothing else matters. Okay, when news hits, we don't know if price is going to go up or down, but it is going to go up, it is going to go down. But we want to look at the print, we want to understand where the conviction levels are, where the weakness levels are, and we want to use what they are telling us to influence our trading decision. Again, nothing else matters. In fact, you can talk to a lot of people who have been stopped out significantly over the last year and a half, 2013 and 2014, because their sell buttons have been nothing more than a contribution to the buyers. I mean, you can logically think about our markets and look at the steep incline and say, well, it's got to pull back, it's got to pull back, because you think that this market has to pull back at some point. But the print and the auction kept telling us all along that buyers kept building platforms and the market kept accepting prices higher and higher. There was never any, outside of wars and news, there was never anything that suggested in the normal auction that we had responsive selling and sellers were beginning to take a stand. So again, what you think should happen in a market and an auction is going to significantly impede your ability to trade effectively. So all of this is to say we have to look at the print, we have to understand the structure of the market using our structure chart, our prints, the order flow, volume profile, to understand what buyers and sellers are telling us. Nothing else matters. It is the only truth that we have in the market. And it is the one thing that should influence our trading decisions, not what we think should happen. So as we look at this, and just had it open on the ES, every market, it's a function of the auction that facilitates price movement. And when you understand the auction process and the guiding principles, the fundamentals, they are the foundation to effectively listen to the market, meaning listen to only buyers and sellers. This is the thing that is going to keep you from taking your stops and throwing them outside of your comfort and what your plan would suggest that you do. And these are also the fundamentals and guiding principles that are going to help you as you look at the print, say, all right, this is working, I'm long, buyers are stepping in. If buyers are truly stepping in, then price should move to this level and help you to hold to those targets. So some of the truths, and again, I want to get through this so we can actually start looking at the print. Some of the truths, a trader, I don't care who you are, a trader trades for profit, that's obvious. Most retail, in fact, any retail trader that I know, they cannot move price. Only buyers and sellers, again, the active market participants can move price. Now you're going to hear me say this over and over again. It's not because I just like to repeat myself or because I want to fill the time. It's really important as a trader that you understand that you have perceptions. You look at bars, you look at candle bars, you look at price moving up and down, you look at order flow, and you make impressions and assumptions and conclusions based on what you are seeing. And it's your impression and your influence on what you're seeing and interpretation that can cause you to miss what is really happening in the market. And so for me to say this over and over is very important. It's the reason why when I look at the print is my truth. It is the one truth in the market that I can see and I can rely on. Doesn't mean every trade is going to work and that somebody may step in and prove me wrong, but I know that if I'm focusing on the print and not what I think is going to happen, I can be much more successful in my trading. You know that indicators cannot move price in any direction, right? So whether you're looking at Fibonacci's or MACD's or stochastics or any other custom indicator, they can possibly show you opportunity, but indicators aren't going to move price. It's still buyers and sellers. Your bias, market blogs, commentaries, forums, market gurus, if you listen to somebody and they say, well, this is going to go up, they're not going to move price in any direction. In fact, all they're going to do is create a bias for you. It's not going to help. The success or failure of any one of your trades is dependent on one thing, and that is all of the bids and offers made by market participants, active participants that happen after you place your trade. And everybody gets this. Every trader that I talk to gets this. They say, well, of course. I mean, if I go long and buyers step in, then I'm likely going to win. If I'm short and sellers step in, I'm likely going to win. That's not necessarily true, because just by the fact that there may be an additional amount of buyers who are lifting the offer doesn't mean that you are necessarily going to win if you're long. And you have to be able to look at what's happening in the print to understand that once you're in a trade, is your risk increasing or is the trade working in your favor? Is what you expect to happen happening? And again, once you place your trade, you've kind of set your leaf in the river and you're letting your trade go. The river will take your trade wherever the river is going to take, or the market's going to take your trade wherever it's going to take your trade, just like a leaf in a river. So you want to make sure that you are buying with buyers and you're selling with sellers. So if you look at those truths and you say, yeah, all of those statements were true, and if you follow the logic, you trade to make a profit, your profit or loss is completely dependent on all the trades that come in after you place your trade, and the fact that only active market participants, buyers and sellers, can affect price after you place your trade, then you should only be listening to or watching the buyers and the sellers, and that is in the print. Those are the only things that buyers and sellers are going to move price after you get into a trade. Nothing else is going to be able to move that price and make your trade win or lose. Nothing else is going to help you to manage your risk. Now, again, I'm going to go over this over and over again because what I know is a lot of people just want to get to their trades. Show me the trade setup, show me the trade setup, show me the trade setups. And what I will tell you is your first job as a trader is to be a risk manager, which means you can identify an area to trade and you get into the trade exactly where you want to get into that trade. But when you get into a trade, you better know where you're wrong, and you better take your stop where you're wrong. I've seen too many traders lose, get kicked out of the business because they get into a trade or several trades. The market starts working against them, and they go into subjectivity mode, and they say, it'll come back, it'll come back, it'll come back. And they keep moving their stop, they keep moving their stop, and they get wiped out. They get wiped out really quick. By the time that we're done with this, using the volume profile and the print, you are going to be able to see why you need to put a stop at a specific spot. And if you get taken out, it's okay. The next question you're going to have immediately in your mind is, okay, I got taken out. What is happening next? Because what is going to happen next is going to determine your next trade. So what you're going to be able to do is you're going to be able to go into a trade knowing that you've defined your risk, and even if you do get taken out in your trade, you have another trade behind that because the market is likely going to give you some information about what it's trying to do. So which one's more likely to make a trader profitable? It's, of course, listening to the market. It's not just being able to read the print, it's being able to trust the print. You have to be able to trust what it is. I mean, I will tell you that OFA has built, in my opinion, the best tool out there to be able to read the electronic auction. It is all you have is truth. So you need to be able to rely on it and trust it for your trades. So I want to get in looking at an actual auction from today. Just a few guiding principles that require some explanation. You understand that buyers create demand by making bids and sellers create supply by making offers. And then price movement just follows the simple rules of supply and demand. There are never ever, and DB has said this before as well, there are never ever more buyers or sellers. And I've heard this a lot from a lot of experts. The market moves from balance to imbalance and back and forth. And we're going to talk more about that and why this is important as we get into looking at probe and rotation and the specific print. The market is composed of different time frame participants with different objectives. What that means is I am a day trader, and sometimes I'm a scalper. And a scalper has a different objective than a day trader, right? If I'm a day trader and I'm trying to catch 5 or 6 points or more on the ES, especially coming in August, I might have to be in a trade for hours. Whereas if I'm a scalper, I may be in a trade anywhere from seconds to minutes or 15 minutes or something like that. And my objective for the trade is very different. And my objective for the trade is very different than the institutional trader who buys at a level and then sells at a level, price comes back down, and then buys again and sells and start managing their profit by selling as they are into profit. And their time frame for the trade may be weeks or months. So the point is that every market is composed of different participants with different objectives. And the cool thing is that the volume profile over time is going to show us those objectives, and it's going to show us the interests and fair and unfair prices for the different time frame participants. And what we're going to see towards day 4 and day 5 is when we can start lining up and getting some confluence between these different time frame participants, and I'm going to show you how to do that. You have amazing confluence for trades. You can identify areas for trades that are going to provide you excellent risk reward. So understanding that the different time frame participants make different swings in the market. So my scalping and high frequency trading creates a swing of maybe 3 points in the ES, whereas a day trader may create a swing of 6, 7 or more points in the ES, and the longer term traders will create 50-point swings in the ES. Understand that and understand how it relates to the volume profile, and you can start building trade plans that line up with those different time frame participants. Last thing here is, this is really important. Price will continue to move in a specific direction, either up or down, until the other side steps in and shuts that movement off. So price moves up until buyers have had enough and sellers say, nope, there's value lower. And that happens in many different time frames throughout the day, throughout the week, et cetera, et cetera. It's what creates a trend. It's what creates our breakouts as the market probes to new levels and gets back into balance. It's what creates the balance and imbalance. So again, buyers create demand by making bids, and sellers, we're just going to go through a little bit of detail here, and then there's supply. Supply by sellers, demand by the buyers. When supply is high, demand is low, price will move lower. This is the basic function of the market. When supply and demand are equal, price will rotate or be range bound, right? So what does that mean, supply and demand are equal? That means that we have rotation in a market. There are specific trading opportunities when the market is in balance. Those trading opportunities are different than when the market is probing new prices. And to understand where those levels are using the print and volume profile will give you different strategies for trading. When supply is low, demand is high, price will move higher. Now some of that's hard to make sense of, so I have a graphic here. When we have aggressive sellers, and we have more aggressive sellers, then not more sellers, but we have more aggressive sellers, price is typically coming down. When we have more aggressive buyers, then price is typically moving up. When we have an area where price is being accepted or there is balance, we have price that rotates. And basically this is a simple chart of supply and demand that creates or is generated from the order flow. And as buyers become more aggressive, their conviction level is higher. What do we want to be trading with? We want to trade with conviction. We use the order flow, we use volume cluster analysis, we use momentum to identify conviction in buyers and sellers. And when conviction gets higher, we can see it in the print, we can see it in momentum, we can see it in the cluster. When their conviction gets higher and they're actually able to start moving price, we know that we can begin trading with them and we are likely to succeed in our trade. So how do we use it? Well, you'll often hear the phrase, there are more buyers or more sellers. I hear it all the time. I hear it on even CNBC. And a lot of people believe this. Price goes up because there are more buyers. Price goes down because there are more sellers. It really only demonstrates how much they really don't know, because the auction doesn't work like that. There are never more buyers, never more sellers, and the quantity of buyers and sellers has nothing to do with price movement. The auction is incredibly efficient in this sense. It requires one buyer for every seller, every transaction, so there can never be more buyers and more sellers. So if it's not the quantity of buyers and sellers, then what moves price? Now, a lot of you know this. What does high or low demand mean? What does it mean to you in your trade? What does high or low supply mean? Why do you even care about that? And this is one of those things I would want you to write down, not because it's on a test and you want to do well on the test, but this is really important. It's foundational to everything else we're going to go through in the week. So if you take one thing away from this morning, make it this, because this was my aha opportunity. This was my aha moment as I started trading so long ago using the auction process. And that is, it is the type of buyers and sellers that moves price, not the quantity. Why do you care? Because remember, you're into a trade to make profit. So what do you care? We understand that only buyers and sellers can move price, and they need to move price in the direction that you care about. And if it's the type of buyers and sellers and you care about price movement after you get into a trade, then you care about how the bids and the offers are coming into the market. And when you can see what kind of buyers and sellers represented by bids and offers, also supported in volume cluster analysis and in momentum analysis, and in the volume profile, when you can see how they are coming in, you have immediate market feedback before and during your trades. Again, there are never more buyers, never more sellers. There are only aggressive and passive ones. Two types of bids, two types of offers. And again, I'm kind of going through some of this quickly. If you have a question, please go ahead and ask. But I don't assume that everybody really gets all of this, especially if you're new to trading the auction process. So I go through this to make sure that we're all at the same place. Two types of bids and two types of offers that represents the two types of buyers and sellers. We have a limit bid and offer, and the limit, or called otherwise known as resting bids and offers, represents passive buyers and sellers, lower conviction. Now, the one time that's different is when these passive buyers and sellers, some people know them as iceberg orders. This is where some people might say dark pools come in, where a big buyer or seller is standing at a specific price and absorbing everything that the other side dishes out. No problem. Limit orders still cannot move price. Limit orders are low conviction. When we see buyers or selling holding the effort of the other side, then it gives us some information and we know what to start to look for relative to price movement. Market bids, market bids and offers represent aggressive buyers and sellers. They show high conviction. And basically the market orders are the one side, buyers saying, I'm willing to pay more. Sellers are saying, I'm willing to take less. Again, limit orders cannot move price. So when you're looking at a dome, I don't care if you're looking at level 1, level 2, if you're looking at a dome, those are all orders that are resting, they're sitting there, they're waiting to be filled by market orders. This is what we look at when we see orders executing at the bid, executing at the offer. But they don't move price. They can hold price, but they're not going to move price. Okay? It doesn't mean that they're not important, because they are part of the auction, and they're very important. But market orders are the only type of orders that moves price up and down. It's why in the print we look at the print relative to the bid and the offer. And when OFA does its weakness and strength comparison, it is always comparing prices at the bid and the offer. It's why we never look horizontally at price at any given time to see the relationship between the buyers and the sellers. Market orders, those orders that are filled at the bid and the offer, are the ones that move price. Those are the ones we care about. That's what's related and shown in the print, and that's what we want to pay attention to and base our trades and our trade management on. So since we make or lose money based on price movement, then what kind of orders do we care about at the time of trade entry and during a trade? Obviously, market orders, or orders traded at the bid or offer. It's also what we're going to start focusing on when we start talking about order management or trade management and risk management. We're going to start focusing on the print. And what I'm going to go through with you is, once we start identifying trades, we're going to watch the print to give us our confirmation that the opportunity is there. Once we're in the trade, then we're going to use the print and what's happening in the print between buyers and sellers to tell us, is the risk in our trade increasing, or is this trade working in our favor? When you can learn to do that, what I will tell you is you will find your psychology, whatever that means to you, your comfort in trading, your understanding of what's happening in the market, and ability to remain objective will significantly improve. Significantly improve.